I'm Lyndsay Malchuk for the Expert Exchange. Another rate cut has been announced, and I'm sitting with Micheal Succurro to continue the conversation on how another cut affects your portfolio. Hello, Micheal. Good morning. How are you?
I'm good. How about you, Lyndsay?
Great. So the latest job report tilted expectations in favor of a 0.5% point cut, which would have been the first cut of the size since the pandemic. So with the announcement being 0.25%, was the cut what you expected?
You know what? It was. At the end of the day, what we were expecting was hopefully at least a 0.25% rate cut, which is what we got. And we were very optimistic about that once we saw the numbers last week about inflation coming down to 1.8%. Obviously, we're hopeful for a half a rate cut, but I totally understand what the government is trying to do. They're not trying to cause a spike in the prices when it comes to purchasing real estate. Because as of right now, even though we've had the rate cuts come down slowly and buyers have slowed down, we still haven't seen a big reduction yet in the price of housing.
Yeah. It was widely expected by analysts as well that the BOC would do a one-and-done jumbo cut of 50 basis points. One analyst, Avery Schenfeld, chief economist with the Canadian Imperial Bank of Commerce, said markets have thrown down their 50 basis point chip on the poker table, betting that the BOC would deliver an interest rate cut of that magnitude. And then he went on even further to say the bank could go as high as 75 basis points as a means of presenting a optimistic growth outlook for 2025. So now again, with the 25 basis point cut, what message is that sending about the optimistic growth outlook?
Well, I still feel there's a lot of optimism around the rate cuts. I think, like I said, it's just going to be a slow play. They don't want to cause a big spike in the market because that's what we saw in 2020 and 2021 with these rate cuts and holding of these rates as the years were progressing, and it caused such a spike, an inflationary spike in the market, which led us into the hot waters that we're in today. So I feel that slow and steady is what they're looking to do here, just to not cause another spike in the real estate market.
Let's tailwind this over to real estate then, starting with individual real estate. Tell us what this means.
Well, the great thing is the new policies are now in full swing that came into play in late November and early December. So again, you have a lot of first-time home buyers that are now able to take advantage of the $1.5 million purchase price range with less than 20% down and a 30-year amortization, as well as existing buyers looking to purchase a new primary residence or an existing residency that's going to be their primary residence, again with the ability to put less than 20% down up to $1.5 million on a 25-year amortization. So it makes it a lot easier to either get into the market or now grow and move up from maybe that condo to that forever home or that townhouse to a family-sized home as you're looking to progress in your life naturally, as you should be when you're looking at purchasing real estate and growing your portfolio.
Okay, so what about REITs? On the surface, this all looks great. However, are these cuts much like an iceberg? It's what's below the surface that is the real story.
Yes, absolutely, because again, default rates are still through the roof. And we have a lot of challenges out there in the market where, again, a lot of these mortgages are finally coming up for renewal starting in March. So we haven't seen that deep effect yet as to what the future holds with a lot of these mortgages coming up for renewal that were in the 1.1, 1.2% range 5 years ago as of, March.
So what's the prediction going forward? Is it going to be a one and done, or you foresee further cuts?
I foresee further cuts, but I don't think it's going to be a one and done. I feel like, again, it's going to be a slow play, 0.25, 0.25, and they're just going to ride that out. The great thing is the Bank of Canada brought it down to 3% right now. So we're only 0.75% away from what we were at in early 2020, as it came as low as 2.25%.
Well, thank you for jumping on with me. You can check out more conversations with Micheal and I on our podcast, Contributors Corner, right here on Stockhouse.com. Micheal, it's been a joy yet again, and we'll see you soon.
Thank you, Lyndsay.
I'm Lyndsay Malchuk, and we will see you next time.